Final accounts for UAE Bikes. These are the financial accounts for UAE Bikes at 31st December 2016. Profit and loss account for UAE Bikes for the year ended 31st December 2016. All values are in thousands. Sales plus non-operational income, such as the interest received, minus the cost of sales gives us gross profit. So 500,000 plus 10,000 minus 230,000 gives us 280,000 as the gross profit. Expenses such as salaries paid, advertising, insurance paid, and the depreciation expense gives us a total of 230,000 in expenses. Gross profit minus expenses gives us net profit before interest and tax. So 280,000 minus 230,000 gives us 50,000 of net profit before interest and tax. After subtracting interest paid, which is 20,000 from the net profit before interest and tax, we have net profit before tax, which is 50,000 minus 20,000, which gives us 30,000 net profit before tax. Since tax is 10,000, we subtract that from net profit before tax, giving us the net profit after interest and tax as 20,000. Since dividends paid are zero, our retained profits would come to a total of 20,000. The balance sheet. UAE Bikes balance sheet as of 31st December 2016. The fixed assets such as equipment 120,000 and building, which is 320,000, add up to give us a net fixed asset of $440,000. Current assets such as stock, which is 50,000, debtors, which is 70,000, cash in bank, which is 90,000, add up to give us total current assets as 210,000. Current liabilities such as overdraft, which is 40,000, creditors, which is 20,000, and total current liabilities after adding up overdraft and creditors would come to 60,000. After we subtract total current assets and total current liabilities, we get the working capital. So 210,000 minus 60,000 gives us the working capital as 150,000. The total assets are then, to get total assets, we add the working capital and net fixed assets. So 440,000 plus 150,000 gives us 590,000 in terms of total assets. Long-term liabilities such as loan, which is 120,000, is then subtracted from total assets to give us the net assets, which is 470,000. The business is financed by share capital and retained profits, where share capital is 450,000 and retained profit is 20,000. When you add them together, you get equity as 470,000. Since net assets and equity are balanced, the balance sheet is successful. Distinguish between a profit and loss account and a balance sheet so the investors know the difference. Use examples from your own statements. So the balance sheet shows the position of the business, whereas the profit and loss statement just shows whether it is profitable. This is shown by that the balance sheet is more for the investors and the profit and loss statement is more for the shareholders. So the balance sheet shows what the business owes, whereas the profit and loss statement does not show that, but it does show expenses. This shows us how the business is, what position the business is in, and what the business owns. So how big is the business, or how small is the business? If a business is much bigger, then they would own much more assets than a smaller business would own. And this is not shown in the profit and loss statement, because the profit and loss statement is just about showing whether the business is profitable or not. So expenses are shown, what the business owes. The assets of the business and what the business actually owns is shown in the balance sheet for long-term and short-term, whereas the profit and loss statement does not cover this. This also shows the position of the business, because we need to know what the business owns and if what they own is more than what they owe to the bank, for example. This shows the position of the business and how developed the business is, as well as we can identify the business structure. The profit and loss statement does not cover this, but does show us the profits of the business. So this is the balance sheet shows the position of the business, as whereas the profit and loss statement just shows whether the business is profitable or not. UAE Bikes is a new business located in Motor City, UAE. The location was chosen for its large active expat community and its proximity to the Al Qudra cycling track. It is co-owned by two British cycling enthusiasts, Aaron and Aaron, which own 70% of the business, as well as a local investor, Osama, which owns 30%. Although they get along with each other, Osama has little to do with the daily running of the business, and he has also made it clear that he has many business investment opportunities if UAE Bikes is not successful, although he has been vague about what that means. So this is the first year of accounts for UAE Bikes, and explain 2 reasons why shareholders might be satisfied with the year. So the business has been profitable is one of the main reasons the shareholders would be satisfied with this year. Because the business is profitable and it is the first year, this shows that the business most likely will grow much more in the future and be much more profitable than they are right now in the future. This shows that it is a good investment, and the shareholders would be content with this because their investment would not go down the drain and would most likely come across to them as being a successful investment due to maybe the profit they will be making in the future or in the present. The business's equity is also larger than the loan. This would be very pleasing to the shareholders because this shows that the business owns much more than what it owes. Because it owns much more than what it owes, the business would have no problem in paying the loan off, and if something does go wrong, the business has a higher chance of standing back on its feet and coming back into the market. This would be pleasing for the shareholders because this again reduces the likeliness of the shareholders' investment going in the drain, and would be appealing to a shareholder because it is a long-term investment they can make and have larger profitability for in the future or the present, such as the business being more profitable. So many of the reasons, two of the main reasons shareholders might be satisfied with the year is because the business has been profitable in its first year and the business's equity is much larger than the loan. So the business owns more than what the business owes.